While most people are fixated on the short term, the real gains for investors are way out in the future. Get the big picture, the big trends right. Your heirs will thank you greatly. Well, JP Morgan Asset Management today released its long-term market assumptions, which give a view for risk and return out for 10 to 15 years. Joining now, Kerry, global market strategist. Can I just say, I don't even know what I'm having for lunch tomorrow, let alone what I'm doing in 10 or 15 years' time. But this is the reality. You've got to get the big picture right, and that's where you place those long-term bets. I'm even, thinking over the past day, Berkshire Hathaway and just, what we've learnt from them over the past few days really is a part of this story, isn't it?
Absolutely. It's thinking about wealth creation. That takes a long time. We have to think about the right mix of assets that delivers that in terms of thinking about your return objectives, the building of that wealth, and again, also your risk profile.
Okay, but what you say is that Australian interest rates cannot stay where they are. 4.35% the cash rate. Doesn't matter what the Reserve Bank does, whether it's another rate rise too, whatever it might be. The reality is, you say, over the very long term, here and around the world, interest rates eventually settle back down.
Absolutely. Whether it's here in the RBA or whether it's thinking about the Federal Reserve in the US, they don't want to be paying you 4 or 5% on your cash. That's not what they want to do. They're trying to bring down that inflation. They're trying to find a point in the economy where it can grow, and that's a lower rate of inflation, that 2% target. And we assume that over the very long term, they still have credibility to achieve that target. So therefore, those cash rates can be lower. And that does mean that those cash returns are much lower as well.
Okay, so if that's the case, then it subsequently follows that investments in bonds look like they would be attractive. The investments in property-style companies or even banks, with those things that pay a dividend, that have a cash flow that come from them regularly, that they would be some of your longer-term assumptions of things where there's value.
Absolutely. When we think about the fixed income returns, especially, we see a large markup in terms of that return potential, because those yields are going to fall from very high levels today back down to what we think they should be, fairly valued in the long run. And so you benefit from that appreciation and that, and you get the benefit of that compounding of those higher interest rates in the early part of that. And again, that does extend into thinking about the performance of the REITs market, for example, or in terms of unlisted assets around property. We see a much bigger uplift in those returns in this year's LTCMAs than we did in last year's.
Okay, so even if there's big pressure there, and some people talking about REITs are looking at them terribly under pressure at the moment and undervalued, that could be the place where people could start to hunt and find genuine bargains.
Absolutely, but it does come with that long-term time frame. We have to think about that volatility.
You've got to survive, for starters.
Exactly.
Right?
We've got to think about that volatility that may appear in the mean term. It is about thinking, not necessarily setting and forgetting, but having that structural view on how you put your portfolio together. And then, as any portfolio manager will tell you, they then tilt around the current part of the cycle to adjust for that, but they build it on that long-term view of what those asset classes should do.
There's also the big geopolitical picture, and you've got to take an assumption on that. The one thing you say here is that there's a disconnect from China. What exactly does a disconnect from China mean?
We are thinking about the impacts of a slowdown in globalisation or deglobalisation to an extent. We're thinking about how governments are spending to fund national policies, whether it's around technology and chip production, which is very much related to the China aspect, or thinking about other measures around sustainability, again, related to what we see within China. But more broadly, when we think about the growth outlook, we have to look at the demographic profile of China. We think about the structuring of the economy and the debt deleveraging that happens. All that just adds up to a weaker growth outlook for the China economy over the long run as it becomes more middle income rather than emerging.
Go back to one thing you just said, because it sent alarm bells, I'm sure, through a lot of people, and that was the state's increasing role in the economy. Most people want the state out of the economy and want to allow business to do it. But you say, no, that's not what's going to happen.
It's one of these legacy impacts from the pandemic, that the government was stepping in. They're willing to spend to drive that growth, to plug that gap. And we see that continuing. Again, we have expectations about a greater role for industrial policy, a greater role for policies to address some of the social inequality issues that become more apparent. And that presents an opportunity for many investors. We think about the real parts of the economy. They're going to be aligned with, say, that technology production element, that greening of the economy as well, or thinking about some of the other goals that governments have around national defence, or thinking about that inequality argument. All that can align itself with things around utilities, with around renewables. We'll think about how it might impact the energy sector more broadly.
Kerry, one thing that's always been almost a surefire long-term trend for investors has been to follow the people, therefore follow the money. Population growth or population prosperity, which you see in China, has been very much a way to cash in and make the money. Is there any sense of where that sort of lies over the next 15 years?
It is about how you raise consumption in many of these economies to address some of those structural shifts that are coming through. We do think about the need to enhance productivity as well. That's where AI fits in a big way. But more broadly, if you have a younger demographic, if you have positive net migration, such as we see here in Australia, you end up with a higher growth rate. And across our developed markets, Australia still has one of the highest growth rate forecasts in our assumptions.
So this is going to be interesting. So the point is, though, you've got to place the bets now. Do you actually stick with that, set and forget? Or is it a case where you've got to constantly monitor? What's your own assumption on that?
It's a case of thinking about how I want to achieve my long-run financial goals and realising that if there's a long-run view around growth, then I need to lean towards growthier assets. I think in the short run, it's more thinking about when is the best place to time and move into that. And again, it is about the timing a little bit in the near term. If you are just thinking long-term, the timing doesn't matter so much because these assets will grow or pay that income that you're after.
Tell you what, Kerry Craig from JP Morgan Asset Management, thanks for lending us your brain and throwing it out that far into the future, Dave. Many thanks for your time.
Thank you.